Okay, let's just jump right into it. If you're even thinking about buying a home in Vancouver's insane housing market, you know that every single dollar, every advantage you can get really counts. But what if I told you there's a simple, three-digit number that could be the key to saving an absolute fortune?
So let's cut right to the chase. We're talking about a typical mortgage in one of the most expensive cities in the country. How much of a difference could a great credit score really make? What do you think? A few $1,000s? Maybe 10, 20,000 over the life of the loan?
The answer? Over $150,000. And that's not a typo. That is the kind of money we're talking about, the potential savings between having a fair score and an excellent one. So you see, your credit score isn't just a grade. It's one of the most powerful financial tools you have. The question is, how do we use it?
To get those savings, we first have to understand what we're actually working with. So let's pull back the curtain on this mysterious three-digit number and see what lenders are really looking at when they see your name.
So what is a credit score, really? Well, here in Canada, it's a number between 300 and 900. Think of it like your financial reputation, all boiled down into a single number. For a lender, it's a super quick way to figure out the risk of loaning you a huge amount of money. The higher your number, the lower their risk, and that means a much better deal for you.
Now, it might seem like this number is cooked up in some secret black box, right? But it's not. The credit bureaus, Equifax, and TransUnion are actually pretty open about the recipe they use. So let's break down the ingredients.
And check this out, because the priorities are surprisingly simple. A massive 65% of your entire score boils down to just two things. First, paying your bills on time. That's your payment history. And second, how much of your available credit you're actually using, which is called credit utilization. Everything else matters, sure, but those first two, they are the whole ballgame.
So what do these scores actually mean in the real world? Well, if you're in that excellent tier, above 760, you're getting the VIP treatment. You're going to see the best interest rates, no question. As you move down the list, your options start to change. In that fair range, you'll probably still qualify, but you're going to pay more for it. And once you dip below 600, you're pretty much looking at alternative lenders with much higher rates.
Okay, so now that we know what the score is and why it's so important, let's get into the action plan. This is the practical how-to guide, the 7 proven strategies you can use to boost that number and put yourself in the absolute best position to buy.
All right, let's start with the heavy hitters. Remember that 35% for payment history? That's totally non-negotiable. Get this, just one missed payment can stay on your report, haunting you for 6 years. The next biggest lever you can pull is that utilization rate. And third, you have to be your own detective. Seriously, errors on credit reports are way more common than you think, and you are the only person who's going to catch them.
Let's zoom in on that second point for a sec, credit utilization, because it's a big one. The magic number to remember here is 30%. So if you've got a credit card with a $10,000 limit, you really want to keep your balance below $3,000. Why? Because when lenders see you're using a lot of your available credit, they see it as a sign of financial stress. Keeping this ratio low is honestly one of the fastest ways to give your score a nice little boost.
And here are the other 4 key strategies. Now, I know it can feel really satisfying to close an old credit card you don't use anymore, but don't. Keeping it open actually makes your credit history look longer, which is a good thing. Also, try to avoid applying for a bunch of new credit cards or loans right before you go for a mortgage. And finally, having a good mix of credit, like a credit card and maybe a car loan, shows you can handle different kinds of debt. And of course, if you have any old debts and collections, clearing those up is absolutely critical.
All right, let's bring this all home. We've decoded the score, and we have our 7-step action plan. Now let's connect it all back to that huge number from the beginning and see exactly how these steps unlock real, tangible savings on a Vancouver mortgage.
This right here, this is where the rubber meets the road. On a typical $900,000 mortgage, just moving from a fair credit score to an excellent one could drop your interest rate by 1.5%. Now, that might not sound like a lot, but over the life of that loan, it adds up to a staggering $115,000 in interest payments that you just don't have to make. That is a life-changing amount of money.
And you know what? There's another huge benefit here. In Canada, every home buyer has to pass something called the mortgage stress test, which proves you can afford payments at a much higher interest rate. A stronger credit score doesn't just get you a better actual rate, it makes it easier to pass that stress test, which gives you more purchasing power in this incredibly tough market.
So, what's the big takeaway from all this? This isn't something you want to put off. While some of these fixes can take a few months to show up on your report, the process has to start somewhere. I love how the source material puts it.
Every day you wait is just a missed opportunity to get your financial house in order for what's probably going to be the biggest purchase of your life.
Which brings us to the final question, and this one's for you. We've covered the what, the why, and the how, so now it's your turn. Looking at all these strategies, what's the one simple step you can take today, right now, to start on that path to a better score and hopefully some massive savings?